What we study right now is inventories, which is module 5. We need to go with the introduction section 5.0.1. Merchandising and manufacturing companies generate revenue and profit through sale of inventory. They represent significant asset on the company's balance sheet. Wholesaler and retailer purchase inventory ready for sale from manufacturers and thus account for only one type of inventory, which is finished goods. But when manufacturers will also have raw material. This typically classify inventory into three different categories: raw materials, WIP, finished goods. WIPs have started the conversion process from raw materials but not yet finished goods ready for sale. Manufacturers may report either the separate carrying amount of raw materials and WIP and finished goods on the balance sheet or simply the total inventory amount. If second is used, they need to disclose the carrying amount of raw materials WIP in footnotes. Inventories and cost of sales are significant items in financial statement of many companies. Comparing the performance of these companies is challenging because of allowable choices of valuing inventories. IFRS permit assignment of inventory cost, cost of goods available for sale to inventories and cost of sales by three count formulas: FIFO, weighted average, and US acceptable US GAAP allows three inventories valuation, which is FIFO, LIFO, of the three inventory valuation referred to, but also allowed the fourth category, which is your last in first out. The choice of inventory valuation method affects the allocation of cost of goods available for sale to ending inventory and cost of sales. Let's see how is the calculation done. Cost of inventories. Over here, cost included in and cost recognized as expense in the period in which they are incurred. Under IFRS, the cost to include inventories are all cost of purchase, cost of conversion, and the cost incurred in bringing inventories to the present location and condition. The cost of purchase include purchase price, import and tax related duties, your transportation cost, insurance, handling, and other costs directly attributable to the acquisition of finished goods, materials, and services. Trade discounts, rebate, and similar items reduces the price paid and the cost of purchases. Yeah, back to the things. So trade discounts, rebates, and similar items reduce the price paid and the cost of purchases. Including those product related costs in inventory means that they will not be recognized as an expense on income statement until the inventory is sold. US GAAP provides the similar description of cost to include in inventory. Okay. Both IFRS and US GAAP exclude the following cost from inventory: if there is any abnormal cost as a result of waste of material, labor, or other production conversion inputs, any storage cost, unless it is the past part of the production process, administrative overheads and selling cost, because selling हुआ ही नहीं तो उसको मैं inventory में कैसे add करूँ? This excluded costs are treated as expense and recognized on income statement in the period in which they are incurred. Uh, Including cost in inventory defers their recognition as expense on the income statement until the inventory is sold. Therefore, including cost in inventory that should be expensed will overestimate profitability of the income statement. Perfect. Let's see the next thing. Inventory valuation method. What are the costs that should be added is first thing that we saw, and how you method it. Generally, inventory purchase cost and manufacturing conversion cost change over time. Allocation of total inventory cost of goods available for sale between cost of sales of income statement and inventory of balance sheet will vary depending upon the inventory valuation method used by the company. As mentioned in introduction, inventory valuation method are referred to as cost formula and cost flow assumption under IFRS and US GAAP. If choice of method result in more cost being allocated to cost of sales and less being allocated to inventory, then would be the case with other method. The chosen method will cause the current year reported gross profit, net income, and inventory carrying cost to be lower if alternate method has been used. Accounting for inventory and consequently allocation of cost has a direct impact in the financial statement. Both IFRS and US GAAP allows companies to use the following inventory valuation method. Specific identification: if there are clothes or if there are cars, then which cars did a retailer, how much did he pay for a particular car, he will know. So therefore he will specifically allocate that cost to the specific identification, first in first out. So if you are buying something at a specified prices, let's say if you are buying grains and you put everything in lot sizes, then you will assume that the first lot that came in has been first sold and you will allocate that cost accordingly. Weighted average cost: you will put an average amount, you multiply the price multiply by quantity and you find out that average rate, and to your closing inventory stock you apply that average rate. These are the three methods. The US GAAP allows company to use additional method, which is your last in first out. So you will always assume that the stock that came last at your place is first sold. Example, in case of fashion products, it is believed that your fresh arrivals are going to be sold first. So this could be a case of last in first out. Or let's say in case of bread, if you go to the shelf, if you see that bread or milk, if it is of your day before, you will buy that more than buying the something which is of 3 or 4 days old. So maybe over here as well, LIFO will work where there's a perishable product. For items with a different nature of use, a different inventory valuation method can be used. When items are sold, the carrying value of inventory is recognized as an expense according to the cost formula. The choice of inventory valuation method would be largely irrelevant if inventory costs remain constant or relatively constant over the time, which is perfect. Given the relatively constant prices, the allocation of the cost between cost of goods and ending value will be similar under each of the four methods. If there are the changing price level, the choice of inventory method have a significant impact on the amount of reported COS and inventory. Under this method, the cost of sales and cost of ending inventory reflect the actual cost incurred to purchase a specific item. This method matches the physical flow of specific items sold and remaining to their actual cost. In the period of declining prices, the cost associated to the units in the ending inventory are lower than the cost assigned to the unit sold. Hmm. So let's say if the amount is 10 at the beginning of the year, and then at the end of the year the amount is 9, the purchase cost. And if I am valuing FIFO, then I will always assume that if I have to buy the stock again at the next year, I will be buying it more at the declining prices, and therefore the value that I will put to my inventory will be the declining prices. Therefore, if there is a declining prices, the cost assigned to the units in ending inventory are lower than the cost assigned to the units sold. Weighted average cost. Again, from same point, in an accounting period, the weighted average cost per unit is calculated as total cost of units available for sale divided by total number of units available for sale in that period. Total cost of goods available for sale divided by total units available for sale. Last in, first out. It is permitted in US GAAP. The method assumes that the newest goods purchased are sold first and the oldest purchased uh, are sold later. The cost of sales reflect the cost of goods purchased or manufactured more recently, and the value of ending inventory reflect the cost of older goods. If there are period of rising cost, the cost assigned to units in ending inventory are lower than the cost of goods assigned to the unit sold, because I'm following the if the rate of purchase was 100 at the beginning of the year and 120 at the close of the year, so I will always believe that the 120 good is sold first. Okay, and therefore it is PNL, and therefore the cost assigned to the units in the ending inventory is lower than the cost assigned to the goods assigned to the unit sold. Perfect. Now we have to do the calculation of, first we saw what is cost, then we saw the method 3 for IFRS and 4 for US GAAP. LIFO is the additional one. Now we have to see the calculation of cost of sales, gross profit, and ending inventory. In the period of changing prices, the allocation of total inventory cost of goods available for sale between cost of sales on the income statement and inventory on the balance sheet will vary depending upon the inventory valuation method used by the company. Uh, this is fine. Now let's see what is this appears to be a new concept. Periodic versus perpetual inventory system. Companies typically record changes to the inventory using either a periodic inventory system or perpetual inventory system. Under periodic inventory system, inventory values and cost of sales are determined at the end of the accounting period. Purchases are recorded in the purchase amount. The total of purchase and beginning inventory is the amount of goods available for sale during the year. The ending inventory is subtracted from the goods available for sale to arrive the cost of sales. सो ओपनिंग प्लस साल में जो मैंने प्रोड्यूस किया या तो परचेज किया लेस जो मेरे पास साल में बाकी रहा इज द गुड्स दैट आई हैव सोल्ड एंड द गुड्स दैट आई हैव सोल्ड आई एम कैलकुलेटिंग द कॉस्ट एसोसिएटेड विद द गुड्स सोल्ड. The quantity of goods in ending is obtained or verified using physical count of the units in inventory. Under the perpetual inventory system, inventory values and cost of sales, inventory ka value and cost of sales are continuously updated to reflect the purchase and sales. Example, if you go to any brand factory or some of the stores, you will see that okay, they have on a daily basis the record of the purchases and addition to the store or closing sales from the store, and therefore they know what is the count over there. If you go to any shopping market, they really know as to what is the count of the product at the store at a particular point in time, which is following a perpetual inventory system. Under the either system, the allocation of goods available for sale to cost of sales and ending inventory is same if the inventory valuation method used is either specific identification or FIFO. In either system, allocation of goods available for sale to cost of sales and ending inventory is same if inventory method is used is either specific identification, yeah, because I know if I have no specific cost, or FIFO. This is not generally true for weighted average cost method. Under a periodic inventory system, the amount of cost of goods available for sale allocated to cost of sales may be quite different using FIFO method compared to the weighted average cost method. The inventory values and the cost of sales are continuously updated to reflect purchase and sale. As a result, the amount of goods available for sale allocated to the cost of sales and ending inventory is similar under FIFO and weighted average cost. Because of the lack of disclosure and dominance of perpetual inventory system, analysts typically do not make adjustments when comparing the company using weighted average cost method with the company using FIFO method. Because of the lack of disclosure and dominance of perpetual inventory system, analysts do not make adjustment. So we don't have to make any adjustment when we are comparing a company using weighted average cost and if a company is using FIFO. Using a LIFO, a periodic and perpetual inventory system will generally result in different allocations to cost of sales and ending inventory. Under either a perpetual or periodic inventory system, the use of LIFO method will generally result in significantly different allocation to cost of sales and ending inventory compared to the other inventory valuation method. When inventory costs are increasing and inventory unit levels are stable or increasing, तो आपके इन्वेंट्री का कॉस्ट बढ़ रहा है और आपका नंबर ऑफ इन्वेंट्रीज जो है वो या तो स्टेबल है या तो नंबर ऑफ इन्वेंट्री आपके पास गोडाउन में इंक्रीज हो रहा है. यूजिंग द LIFO मेथड विल रिजल्ट इन हायर कॉस्ट ऑफ सेल्स. ओके, क्योंकि आपके पास ज्यादा स्टॉक पड़ा है एंड आप ज्यादा स्टॉक को पुराना वैल्यू दे रहे हो, which means that you are P&L debiting more and more cost that is at the higher price because the inventory cost is increasing uh, and lower carrying and आपका inventory के लिए आप lower carrying amount use कर रहे हो. The higher cost of sales under LIFO will result in lower gross profit, lower operating income, less income before taxes, and less net income. Income tax expense will be lower under LIFO, causing net company's cash flow to be higher. On the balance sheet, the lower inventory carrying amount will result in lower reported current assets, lower working capital, and lower total assets. So the analyst has to carefully assess the financial statement implications of the choice of inventory when comparing companies using LIFO with others. So if you are doing either FIFO or weighted average, then there is no much change required. But if you are doing LIFO, you need to consider the impact. Now, we have to compare the inventory valuation methods. As shown in example 2, the allocation of total cost of goods available for sale to cost of sales on income statement and the ending varies based on different valuation method. If there is a declining inventory unit cost or increasing inventory quantities, FIFO will allocate higher amount to the total cost of goods available for sale to cost of sales on income statement and a lower amount to the closing inventory. Because of the cost of sales will be higher under FIFO, the company's gross profit, operating profit, and income before taxes will be lower. If an environment is of the rising inventory cost or increasing inventory quantities, FIFO in comparison with weighted average cost or LIFO will allocate a lower amount of total cost of goods available for sale to cost of sales on income statement and a higher amount of the ending inventory. Accordingly, because cost of sales will be lower under FIFO, the company's gross profit and PBT will be higher. Perfect. Now, LIFO method and LIFO reserves. So, the potential income tax savings are a benefit of using LIFO method when inventory costs are increasing. Because your inventory cost are increasing and you believe that the last product is sold first, you will have a more bigger amount which is debited to your profit and loss, which will inter alia result in income tax saving. The higher cash flow due to lower income taxes may make the company more valuable because the value of the company is based on present value of the future cash flow. However, under the LIFO method, ending inventory is assumed to consist of those units that have been held the longest. This generally results in ending inventories with carrying amount lower than the current replacement cost because inventory cost typically increases over time. Cost of sales will more closely reflect current replacement cost. If the purchase price or production cost of inventory are increasing, income statement consequences of using LIFO method compared to the other method will include higher cost of sales. If you are increasing, it means that the P&L is higher in case of LIFO method. Lower gross profit, lower operating profit, and on the asset side, you will have a lower ending inventory, working capital, total assets, retained earnings. The lower income tax paid will result in higher net cash flow from operating activities. Some of the financial ratio effects are on lower current ratio, higher debt to equity ratios, and lower profitability ratios. Let's understand the last statement. Some of the financial ratio effects are on account of LIFO, where the cost of goods is increasing, is that your asset, okay, your inventory value is lower. Because your inventory value is lower, your current asset is lower, and because your current asset is lower, your current asset divided by current liability, which will be your current ratio, will be lower. Because the value of your inventory is lower, it means that you have lesser profitability during the current year because you have parked the cost of higher amount in profit and loss account, and because of this your profitability is lower, and because your profitability is lower your equity is also lower, and because of this there is going to be higher debt to equity ratio because the amount of equity has reduced. Debt divided by equity, if the equity amount is reducing, you will have a higher debt to equity ratio. And obviously, because as I told you, the profit is going to reduce, your profitability ratio is also less. Your net profit divided by sales will be lesser. If the purchase price or production cost of the inventory are decreasing, if they are decreasing, it means that you have parked more amounts to the profit and your value at your closing inventory is higher. It means uh, the exact opposite of whatever we spoke in terms of ratio. Yeah, will be opposite to the effect of the periods of the increasing cost. So it means that there will be lower debt to equity ratio, there will be higher profitability ratio, and there will be a higher current ratio. Now let's see what is the LIFO reserve. For companies using LIFO method, US GAAP requires disclosure in the notes to the financial statement or on the balance sheet of the amount of LIFO reserve. And LIFO reserve is what? It is difference between the LIFO reported inventory carrying amount and the inventory amount that would have been reported if FIFO amount was to be used. तो अगर FIFO होता तो क्या होता और LIFO है तो कितना है? तो दोनों का जो difference है is the LIFO reserve, and where it needs to be disclosed is required as a notes to the financial statement or in the balance sheet. It's optional. The disclosure provides the information that analysts need to adjust the company's cost of sales and ending inventory balance based on LIFO method to FIFO method. To compare companies using LIFO with the companies not using LIFO, the inventory is adjusted by adding undisclosed LIFO reserves to the inventory balance sheet that is reported on the balance sheet. Okay. So क्या करना है? To compare companies using LIFO with the companies not using LIFO, inventory adjusted is adding the disclosed LIFO reserves to the inventory balance that is reported on the balance sheet. The reported inventory balance using LIFO plus LIFO reserve equals to the inventory that would have been reported under FIFO. Cost of sales is adjusted by subtracting the increase in LIFO reserve during the period from the cost of sales during the year that is reported on the income statement. If the LIFO reserve has declined during the year, the decrease in the reserve is added to the cost of sales amount that is reported on the income statement. The LIFO reserves disclosure can be used to adjust the financial statement of US company using LIFO method and make it comparable to FIFO method. So LIFO reserve is a new concept. LIFO reserve is difference between FIFO and LIFO. It needs to be adjusted if there is increase in LIFO reserve, then you will adjust your, you will adjust, increase the value of inventory, and if you have to adjust the value in inventory, it means you will have to reduce your cost of sales. Okay, and if there is reduction in LIFO reserve, it means you have to reduce your inventory and therefore you have to increase your cost of sales. Decline, the decrease in the will be added to the cost of sales. Perfect. Perfect. And that was LIFO reserve. Now there is one more new concept of LIFO liquidation. Why is this a new concept? Because we have read IFRS or Indian GAAP. In all that concepts, we were not having that much of LIFO. Our focus was always FIFO, weighted average, or specific identification. And therefore, this LIFO reserve and LIFO adjustments, LIFO liquidations, are new concept. Now let's say what is LIFO liquidation. In period of rising inventory cost, the carrying amount of inventory under FIFO in the period of rising inventory cost, मतलब पहले 100 था, अब 150 है. The carrying amount of inventory under FIFO will always exceed the carrying amount of inventory under LIFO. The LIFO reserve may increase over time as a result of increasing difference between the older cost used to value inventory under LIFO and the most recent cost used to value inventory under FIFO. Also, when the number of inventory units manufactured or purchased, if the number of inventory units manufactured or purchased exceeds the number of units sold, the LIFO reserve may increase as a result of addition of new LIFO layers. The quantity of inventory units is increasing, and each increase in quantity creates a new LIFO layer. When the number of units sold exceeds the number of units purchased, the number of units in the ending inventory is lower than that of the beginning of the year. Okay, and the company uses LIFO will experience LIFO liquidation. Some of the older units held in inventory are assumed to have been sold. If inventory unit cost have been rising for the period to period and LIFO liquidation occurs, मतलब मैंने इस साल पहले के साल की इन्वेंट्री बेची, उसका मतलब इसके पहले के साल की थोड़ी इन्वेंट्री बाकी है. This will produce an inventory related increase in gross profits. This will produce an inventory related increase in gross profits. The increase in gross profits occurs because lower inventory carrying amount of liquidated units. Okay, if it was 100 and the new cost is 150, okay, and it means that I have sold goods of 150 all plus the goods of 100 also. And because the carrying amount of the goods that I have sold is less than 150, which is 100, it results in higher profitability in year 2, where there is when this goods have been sold in year 2. Okay, this will produce an inventory related increase in gross profits. Perfect. The increase in gross profit occurs because of the lower inventory carrying amount of the liquidated units. Let's take an example. Let's say gold. Last year the amount was 100 and this year if the amount is rupees 150. Or let's say silver, the opening balance was 100 and the amount during the entire year was 150. It means that if I have sold everything which I have bought at 150, it means that at the end of the year there will be some inventory left which is of the value of rupees 100. Plus, during the year when I have sold the things, I have sold the things of the value of 100 at the same market rate at 200, yielding to the excess profit of 50, which is 200 minus 100. So the amount of profit on the purchase and sale which I do during the year is 200 minus 150, which is 50, plus the profit which I do on things or from the goods that are in my go down from the earlier year, which I bought for rupees 100. So 200 minus 100 is a profit in the second case. Have been okay. It will result in higher profit. The increase in gross profit occurs because of the lower inventory carrying cost of the liquidated units. The lower inventory carrying amounts are used for cost of sales and sales at the current prices. The gross profit of this unit is higher than the gross profit that would be recognized under the current cost. Uh, this inventory profit caused by LIFO liquidation, however, are one-time events and not sustainable. The LIFO liquidations can occur by a variety of reasons. The reduction in inventory levels may be outside of the management control. Labor strike at the supplier may force a company to reduce inventory levels to meet the customer demands. In the period of economic recession or customer demand is declining, they may choose the existing inventory levels rather than invest in the new inventory. Should be aware that the management can potentially manipulate and inflate their company's reported gross profit and net income at the critical times by intentionally reducing inventory quantities and liquidating older layers of LIFO inventory. During the economic downturns, LIFO liquidation may result in higher gross profit that would otherwise be realized. Okay? Because of this, your overall gross profit is going to be higher. If LIFO layers the inventory are temporarily depleted and not replaced by the fiscal year end, LIFO liquidation will occur, resulting in unsustainable higher gross profit. Therefore, it is imperative to review the LIFO reserve footnote disclosure to determine if LIFO liquidation has occurred. A decline in LIFO reserve for a prior period may be indicative of LIFO liquidation. LIFO liquidation कब हो सकता है जब आपका LIFO reserve decline हो. जब आपका LIFO reserve decline हो, this could be indicative of LIFO liquidation. अब LIFO liquidation है तो उसका करना क्या है? Let's say if there's a fan company sells high quality fans and has been in business since 2015. It uses LIFO method and the periodic inventory system. What is RF 2018 gross profit? What amount of RF gross profit is due to LIFO liquidation? ठीक है, चलो देखते हैं कौन से साल में 2018 में कैलकुलेट करना है. So 2015, 16, 17, 18, each year they are purchasing 12,000 fans. The cost has been increasing from $100 to $115. Each year they are selling something. 2016 they have sold everything from their purchase. 2017 they have sold everything from the purchases. because it is following LIFO. It means that 2018 they have sold everything from their purchases plus they have sold 1000 goods from the 2015 purchase where the amount was 100. It means that 15 extra over 100. So 15 multiplied by 1000 quantity is equals to 15,000 is something that is in excess. Uh, just from a cost perspective. Yeah. Goods available for sale. Ending inventory is this. Okay. Uh, cost of goods available. Okay. Now, what is the question? What amount of RF gross profit is due to? 15,000 should be the answer. RF reported gross profit for the 2018 is RF gross profit due to LIFO liquidation is 15,000. Had purchased 13,000 in 2018 rather than the 12,000 fans. The cost of goods under LIFO would have been 149, and reportedly gross profit would have been 13,000. Perfect. Understood. Now, if you are following one method and if you have to change your method, then what is it that you do? Companies on rare occasions change inventory valuation method. Under IFRS, a change in method is acceptable only if this results in financial statements providing reliable and more relevant information about the effects of transactions, other events, and conditions on the business entity's financial position. If change is justifiable, then it is applied retrospectively. अगर आपने कोई change किया तो फिर उसका impact हम लोग को करना पड़ेगा retrospectively. If you are changing a method, then that impact has to be retrospective. This means that a change is applied to comparative information for prior period as far as practicable. The cumulative amount of adjustment relating to the periods prior to those presented in the current financial statement is applied to the opening balance of each affected component of equity. Example, retained earnings or comprehensive income of the earliest period presented. If the company changes its inventory valuation in 2018 and if it presents 3 years comparative financial statements in its annual report, it would retrospectively reflect this change as far as possible. These changes would be reflected in the 3 years of financial statement presented. 16, 17 will be restated as if the new method had been used in those period years, and cumulative effect of the changing on the periods prior to 2016 will be reflected in 2016 opening balance of such affected component of equity. An exemption to restatement applies when it is impracticable to determine either the period specific effects or the cumulative effect of the change. Under US GAAP, this is what we saw it for IFRS. So if you are having 3 years, then you have to restate for the earlier years and for the amount prior to that, for the impact for the year prior to that, for prior to 2016, you have to put that in your, let's say, equity reserves. But in US GAAP, the conditions to make a change in accounting policy and the accounting from the changes in inventory are similar to IFRS. However, it requires company to thoroughly explain why the newly adopted inventory accounting method is superior and preferable to the old method. If the company decides to change from LIFO to another method, it requires a retrospective restatement as described. However, if it decides to change to LIFO, it must do so on prospective basis and retrospective adjustments are not made to the financial statement. Wow. So as per US GAAP, if you are going from LIFO to FIFO, then you have to do a retrospective adjustment. But if you are going from FIFO to LIFO, then you have to do it prospectively. Should carefully evaluate change in inventory valuation method. Although stated reasons for inventory may be better, match inventory cost with sales revenue or some plausible business explanation. The real underlying and understated purpose may be to reduce income tax expense if changing from LIFO to FIFO or average cost, or to increase reported profits if changing from LIFO to FIFO or average cost. As always, the choice of inventory valuation can have a significant impact on the financial statement, financial ratios that are derived from them. As a consequence, analysts should carefully consider the impact and difference in inventory valuation method when comparing financial statements. Perfect. Coming on to the new topic, which is inventory adjustments. Now, what do you need, or what do you need to be assured of when you're doing inventory adjustments? Describe the measurement of inventory at the lower of cost or net realizable value. Uh, Describe implications of valuing inventory at NRV for the financial statements and ratios. Significant financial risk can result from holding of inventory. Obviously, there are many financial risks if you are holding inventory in the shelf. The cost of inventory may not be recoverable due to it may get spoiled, it may get old. If there are old clothes, new design, not new design, it will just get obsolete, or there is no good technology for it. If you go to the market and say, okay, I need iPhone 13, you will not find it. Even if you find it, if there are many iPhone 13, you will not go to the market and buy iPhone 13 because it's quite old. um, or decline because of the declining sales price, it's not possible to sell it. The IFRS states that the inventory shall be measured and carried on at the lower of the cost at NRV. The NRV is estimated selling price in the ordinary course of business less the estimated cost necessary to make the sales, and estimated selling price is the ordinary course of less the estimated cost necessary to make the sale and estimated cost to get the inventory in condition for sale. Okay. The assessment of NRV is typically done item by item or by group of similar related items. In the event that the value of inventory declines below the carrying amount on the balance sheet, the inventory carrying amount must be written down to the NRV and the loss recognized in the income statement. This expense may be included as a part of cost of sales reported separately. ठीक है, अगर मैंने गुड्स बनाया, आईफोन 13 कंपनी ने बहुत से खरीदे थे बट बहुत से बिके नहीं, दे आर देयर इन द इन्वेंट्री, he bought that for 100,000 let's say, and the value or the net realizable value for now is 80,000. उसको पता है ये बेच के मेरे को 80,000 ही मिलेगा और मैंने 1 लाख का खर्चा किया था. Then what he will do, for 20,000 he has to recognize a loss. उसको पता है कि बिजनेस में धंधा मेरा लॉस हो गया है, इफेक्टिवली मैं मार्क टू मार्केट कर रहा हूँ for that inventory level. So he will recognize an expense of 20,000 or he will book that loss for 20,000. In each subsequent period, a new assessment of NRV is made. A reversal of the amount original is required for subsequent increase in the value of inventory written down. But अगर let's say for some reason people altogether decided that okay, मेरे को बड़ा phone नहीं पसंद आ रहा है, I want a smaller phone, and therefore the demand for iPhone 13 increases substantially, or that let's say the sub-Saharan or let's say African market wants to buy Apple product at a cheaper rate, and therefore the rate for iPhone 13, there is a market of iPhone 13 in that, and therefore NRV again become 110,000, which means that I will need to recover or reverse the amount of write back which I had earlier done. It is recognized as a reduction in the cost of sales because आपका cost of sales कम हो गया अभी. Under US GAAP, inventories measured using methods other than LIFO and retail inventory method are measured at lower of cost or NRV. अगर आप other than LIFO कर रहे हो या तो other than retail inventory method कर रहे हो तो आपको cost और NRV whichever is less करना है. For LIFO, या तो रिटेल इन्वेंट्री मेथड में आपको मेजर करना है लोअर ऑफ द कॉस्ट और मार्केट, सॉरी, lower of the cost or market. This broadly consistent with IFRS with one major difference. US GAAP prohibit a reversal of write-downs. Perfect. Write-downs is permitted under IFRS, but write-downs, reversal of write-downs is not permitted under US GAAP. I repeat, reversal of write-downs is permitted under IFRS, जो सहारन सब सहारन मार्केट का जो मैंने बताया, but in US GAAP the reversal of write-downs is not permitted. For inventories measured using LIFO and retail inventory method, जब आपने inventory measure किया है LIFO, the market value is defined as current replacement cost subject to upper and lower limits. The market value cannot exceed net realizable value. The lower limit of market price is net realizable value less a normal profit margin. The lower limit is market value is net realizable value less a normal profit margin. Any write down to the market value or NRV reduces the cost of inventory. It reduces the cost of inventory. आपकी वैल्यू सीधी कम हो जाएगी. And loss in the value is generally reflected in the income statement. This reduces both profit and the carrying value of the inventory on the balance sheet and thus has a negative impact on profitability, liquidity and solvency ratio. तो राइट डाउन की वजह से आपकी नेगेटिव इम्पैक्ट आती है किस पे? प्रॉफिटेबिलिटी, बिकॉज प्रॉफिट एंड लॉस में एक आइटम बढ़ गई. लिक्विडिटी, बिकॉज आपका करंट असेट्स कम हो गया. एंड सॉल्वेंसी, बिकॉज आपका टोटल असेट्स भी कम हो गया. However, the activity ratio, for example, inventory turnover and total assets turnover will be positively inventory to turnover because आपकी inventory value vis-a-vis turnover reduces. Inventory divided by turnover higher होती है अगर आपकी inventory value higher है, but आपकी inventory divided by turnover अगर कम है, या तो total assets divided by turnover भी अगर आपका कम है, it will be positively impacted in that way. Your activity ratios will be positively impacted, but your profitability, liquidity, and solvency ratios will be negatively impacted. The negative impact on some key ratios due to decrease in profit may result in reluctance by some companies to record inventory write-downs unless there is strong evidence of the decline of the inventory is permanent. This is especially true under US GAAP where reversal of write down is prohibited. तो आप यूएस में हो और आपको पता है कि ये रिवर्सल आपको होने नहीं वाला है, तो जब तक आप पक्का श्योर नहीं हो कि अरे भाई ये रिडक्शन परमानेंट है, you will not record write-off of the inventory. IAS 2 does not apply to inventories of producers of agriculture and forest products and minerals and mineral products, not to the commodity broking traders. These inventories may be measured at NRV uh, according to the well-established industry practice. If an active market exists for this product, the quoted price is that market is appropriate basis of determining the fair value of the assets. If an active market does not exist, they may use market determined prices or value most recent transaction price. US GAAP is similar to IFRS in treatment of inventories of agricultural and forest produce and mineral ores. Mark to market inventory accounting is allowed for bullion. If you are in bullion, then mark to market is allowed. Going on to the next topic. Disclosures are useful when analyzing a company or following disclosures are required. Accounting policies adopted, total carrying value of inventories and classification. Example, raw material. If it is not in FS, then you will need to put it in the notes. The carrying value of inventories, amount of inventories recognized as expense, the write down of inventories recognized as expense, reversal of write downs, circumstances that led to the reversal of write downs, and if any of the inventories is pledged as securities. And this is similar in both except for F and G because it is not generally allowed in US GAAP. Now, what are the key inventory ratios? The three ratios often used to evaluate the efficiency. आप अपने इन्वेंटरी को कितने अच्छे से मैनेज करते हो आर इन्वेंटरी टर्नओवर रेशियो, days of inventory on hand, and gross profit margin. This ratio are directly impacted by the company's choice of inventory valuation method. Should be aware, however, that many other ratios are affected by the choice of inventory valuation method, although less directly. This includes your current ratio because inventory is component of the current assets, return on asset ratio because cost of sales is key component in deriving your return on income, and inventory is a component of the total assets, and even debt to equity ratio because cumulative measured net income from the inception of business is an aggregate component of the retained earnings. The inventory turnover ratio measures the number of times during the year a company sells its inventory. The higher the turnover ratio is measures the number of times during the year a company sells its inventory. Example, let's say 100,000 divided by 1000, which is 100. उसके पास जितना स्टॉक है उससे 100 टाइम स्टॉक वो बेचती है. That's the inventory ratio. Inventory turnover ratio measures the number of time during the year a company sells its inventory. The higher the turnover ratio, the more times the inventory is sold during the year, and lower the relative investment of resource in inventory. Okay. Let's say if you go to a shop to eat samosas, and he is going to sell 500 samosas during a day, and if he has 50 samosas at that place, it means that he sells 10 times of samosas of the stock that he generally has. So that's the indication of how much times of my stock is my level of sales. The higher the turnover ratio, the more is the inventory sold, and lower the relative investment of resource in inventory. Days of inventory on the hand can be calculated as days in the period divided by inventory turnover. Days in the period divided by turnover. So मेरे को total sale करने के लिए 365 divided by total sale. तो मेरे को फॉर $1 सेल करने के लिए मेरे को कितना दिन लग रहा है, दैट्स द डेज ऑफ इन्वेंट्री ऑन हैंड. और मतलब इट विल गिव मी कि $1 सेल करने के लिए मेरे को इफेक्टिवली इतना टाइम लग रहा है, मल्टीप्लाइड बाय द अमाउंट ऑफ इन्वेंट्री कैन टेल यू कि कितने दिन की मेरे पास इन्वेंट्री बाकी है. ओके. The days of inventory on hand can be calculated as days in the period 365 divided by inventory turnover. Thus, inventory turnover and the days of inventory on the hand are inversely related. Inventory turnover and days of inventory on. Okay. It may be that inventory turnover, however, is calculated using average inventory in the year, whereas days of inventory on hand is based on ending inventory amount. Yes. In general, inventory turnover and the number of days of inventory on hand should be benchmarked against the industry norms and compared across years. The higher inventory turnover ratio and low number of days of inventory on hand might indicate the higher effective inventory management. और आपका अगर higher inventory ratio है and low number of days of inventory on hand could indicate that the company does not carry an adequate amount of inventory, or that the company has written down inventory values. Inventory shortage could potentially result in lost sales or production problems in case of raw material inventory of the manufacturer. To assess which explanation is more likely, analysts should compare companies' inventory turnover and sales growth rate with those of the industry and review the financial statements disclosures. Slower growth combined with higher inventory turnover, अगर मार्केट धीरे धीरे चल रहा है और आपका हायर इन्वेंट्री टर्नओवर would indicate inadequate inventory levels. Write-downs of inventory could reflect poor inventory management. Minimal write-downs and sale growth rates at and above the industry would support the interpretation that higher turnover reflects higher efficiency in managing inventory. A lower inventory turnover ratio, अगर आपका इन्वेंटरी टर्नओवर रेशियो कम है and high low inventory turnover ratio and high number of days of inventory on hand relatively to the industry could be indicator of slow moving and obsolete inventory. आपका जो इन्वेंट्री डिवाइडेड बाय सेल्स अगर हाई है या तो आपको नंबर ऑफ डेज की आपके पास जो इन्वेंट्री बाकी है वो हाई है, इट मीन्स दैट योर ग्रोथ रेट और लेट्स से योर सेल इज स्लोअर इन द मार्केट or your product has become an obsolete. Again, comparing the company's sales growth across years and with the industry and reviewing financial statements can be an additional insight. The gross profit margin, the ratio of gross profit to sales, indicate the percentage of sales being contributed to the net income as opposed to the covering of the cost of sales. Firms in highly competitive industry generally have lower gross profit margins than firms in industries with fewer competitors. Example, Jio and Airtel will have higher profits because of the lesser competitors. A company's gross profit margin may be function of type of its product. Company selling luxury product will generally have higher gross profit margins than companies selling a staple product. The inventory turnover of a company selling luxury product, however, is likely to be lower than the inventory turnover of a company selling staple product. Fair enough. Let's go to the summary of this. The choice of inventory valuation method, cost formula or cost flow assumption can be potentially significant impact on inventory carrying cost and the cost of sales. This in turn impact other financial statement items such as current assets, total assets, gross profits. Inventories are major factor in analysis of manufacturing company. The total cost of inventories comprises all the cost of purchase, cost of conversion, and other costs for bringing inventories to the present location. Storage cost of finished goods and abnormal cost are not considered. Allowable inventory valuation implicitly involve different assumptions about cost flows. The choice of inventory method determines how cost of goods available for sale during the year is allocated between inventory and cost of sales. COGS का adjustment between COS and inventory. IFRS allows three, while US GAAP allows one. The company must use a same cost formula for all the inventories having similar nature. An inventory accounting system may result in different values for cost of sales and ending inventory when weighted average cost or LIFO inventory is used. But in but under FIFO or specific allocation, the amount will not be materially different. Under US GAAP, companies that use LIFO must disclose the financial notes of the LIFO reserve that would be reported in inventory if the LIFO method has been used. LIFO liquidation occurs when the number of units in the ending inventory declines. उसका मतलब परचेज में से आप सेल कर रहे हो. Consistency of inventory costing is required under both IFRS and US GAAP. Under the IFRS, inventory are measured at lower of cost and NRV. Under US GAAP, inventories are measured at lower of cost and NRV depending upon the inventory method used. Market value is defined as current replacement cost subject to upper limit of net realizable value and lower limit of NRV less normal profit margins. Reversal of inventory write-off is allowed under IFRS but not under US GAAP. Changes in carrying value within inventory classification should be disclosed. The inventory turnover ratio, inventory divided by turnover, the number of days of inventory ratio and gross profit margin ratio are useful for evaluating the management of companies inventory. Inventory management have substantial impact on companies activity, profitability, liquidity, and solvency. It is critical to be aware of the industry trends and management intention. Financial statements disclosure provide information regarding accounting policy adopted in measuring inventories, principal uncertainties. This information should assist in evaluation of the company's inventory management. We are done with this chapter now. Thank you.